Well, I'm here again with Jim Rickards. He's from the States. I'm from Argentina. We want to contact him in order to talk about the coming soon Fed policy that it's coming and how that could affect the world, the commodity prices, and then we are going to talk about just a little about Latin America, maybe focus in Argentina with Macri and what can we expect for next year. Well, thank you again, Jim, for being with us again.
Thank you, Diego. It's great to be with you. I'm going to talk a little bit about the policy of our central bank, the Federal Reserve. And I think it's fair for investors in Argentina and Uruguay and Brazil and throughout South America to say, well, why should we care so much about the U.S. central bank? What's the big deal? Well, it would be better if the central bank were not so powerful. But unfortunately, over 60% of global reserves and over 80% of global payments are in U.S. dollars. And so when you are the central bank of the U.S. and you manipulate interest rates, you're manipulating the dollar. This affects everybody. It has impacts in inflation, deflation, commodity prices. It moves through the currency channels. This is what the currency wars are all about. Of course, the currency wars have been going on since 2010. So for better or worse, we live in a very densely interconnected world. We live in a world in which U.S. central bank policy does affect everyone, even though that's not necessarily the most desirable outcome. So what's on tap? Well, on December 16th, the Federal Open Market Committee, that's the part of our Federal Reserve System that makes interest rate decisions, is going to raise U.S. interest rates for the first time, really in almost 10 years. They cut interest rates in 2007, 2008. They kept them at zero from 2008 to 2015, but the last time they raised interest rates was 2006. So it's been almost 10 years since anyone has seen a rate increase. One of the unpredictable factors, there are a lot of traders and investors. You could be, 35 years old, and the last time the Fed raised rates, you might have been in college or grad school. A lot of people on the trading desk have never seen a rate increase. I've seen several of them. They can be very devastating, very dangerous. We saw meltdowns in 1994 when the Fed started to raise rates. And then before that, we saw a bond market rally in March of 1987, 6 months ahead of the U.S. stock market losing 22% of its value in a single day. So these things can be very disruptive. Let's see what happens. But anyway, the Fed's going to raise interest rates on December 16th. It's not 100% certain, but it's at this point, you'd have to say 94% certain. But this is going to be one of the greatest mistakes, one of the greatest blunders in the history of the Federal Reserve. The reason for that is the U.S. economy is fundamentally weak. There is this notion out there that somehow the U.S. economy is strong, that we can stand higher interest rates, we can stand a strong dollar, and that's a normal cycle, but it's not true. It's only true in the Fed's models. If you look at the Fed's models, the ones that Janet Yellen looks at, those models do show continued growth. They show higher inflation, and if any of that were true, it might be a good reason to raise rates. But the Fed's models are deeply flawed. They actually have the worst forecasting record of any institution I can think of. Go back over the last 6 years, look at the Fed's forecast 1 year forward. So, for example, in 2009, they have a forecast for 2010. 2010, they have a forecast for 2011, and so on. They have been wrong by orders of magnitude 6 years in a row. I mean, not just missing by a little bit, but missing by a lot. So they have a terrible forecasting record. Now they're about to raise interest rates based on a forecast. I think it's a good assumption that the forecast is wrong. But it's not just an assumption. The U.S. data is coming in very weak. Inflation is nowhere near the Fed's targets. A lot of indicators are flashing recession. World trade is contracting. In our last trade deficit report, people focus on the U.S. trade deficit or surplus. But what struck me is that imports and exports both declined. Both went down. That means world trade and U.S. trade are contracting. So forget about deficit or surplus. Just look at the absolute levels of imports and exports. They're declining. Same is true around the world. Brazil, of course, is in a very deep recession, almost a depression. Canada is on the verge of recession. Russia's in recession. Japan's in recession. Go around the world and you see very negative signs everywhere. China's slowing down. U.S. is slowing down. So we have this perfect storm where the Fed is just about ready to tighten interest rates, but all the economic data is weak. So they're going to tighten into recession and make things worse. So my expectation is they may tighten, at least one, maybe two or three more times. But by late 2016, they're going to have to go back to easing because probably the U.S. economy and the world will be in a recession. Short run, what does this mean for Argentina? What does this mean for Latin America, South America more broadly? Well, it's going to keep making the dollar stronger. That's going to hurt commodity prices, which are mostly denominated in dollars. Going to slow down world growth. So this is a very serious mistake by the Fed. They'll probably add to the growing pressure for a world recession and certainly U.S. recession in 2016.
Okay, Jim, maybe when do you think that the Fed will be easing again its policy into the second semester of next year? Could it be, or can we see a bottom in commodity plunges for that period, or we have to wait the whole next year?
I think this will happen probably by late 2016, second semester of 2016. Now, the thing that's important to understand about the Federal Reserve, they're always the last to know. They're not really connected with the real world. I mean, you can have a model where you can actually look at actual data. I like to look at actual data. I travel quite a bit. I travel on 5 continents. As you know, we met recently in Nicaragua. I was in Argentina just a few months ago. I've been to the Middle East, South Africa, Europe, etc., around the world, Asia, South Asia, a few months ago. So I travel quite a bit. I look at quite a few indicators. All of the data I'm seeing and all the conversations that I'm having show weakness around the world. But the Fed doesn't have those conversations. They really should get out more, as the expression goes. They're looking at models. Their models are telling them that the economy is strong, but the actual data is showing that the economy is weak. Well, what that means is that the Fed is going to actually have to see some very negative data, perhaps negative GDP, either this quarter, fourth quarter 2015, first quarter 2016, before they change their mind. And the other thing, the Fed never does anything quickly. It takes them, look how long it's taken them to decide to raise rates. They've been talking about this for 2.5 years. I mean, this conversation started in May 2013 when the then Fed Chairman Ben Bernanke first raised the question of tapering. Of course, tapering means reducing asset purchases. So that's how they print money, is they buy assets from the market. That's how the Fed prints money. Well, at the time, May 2013, they were printing about 85 billion US dollars per month. And just the mention of a reduction, bearing in mind they'd still be printing, they'd just be printing less, which is a form of tightening. Just by talking about it, it caused emerging markets meltdown, capital outflows from developing economies back to the U.S., the beginning of a strong dollar, etc. They didn't actually start tapering, so-called, until December 2013. They finished the taper in November 2014. They removed forward guidance, which is a promise not to raise rates, in March of 2015, and they've been talking about raising rates ever since. That is the Fed. So this tightening by words, if not deeds, has been going on for 2.5 years. So it took them that long to actually make the move, which they're going to do next week. So how long will it take them to get the wake-up call and realize that they have to ease? I think this will be, it's not going to take 2.5 years. I think this bad data will really show up by the middle of 2016. But this is something I would expect to see in late 2016. So between now and then, expect more Fed tightening, stronger U.S. dollar, weaker commodity prices, but very bad economic data around the world. And then the Fed will be, as I said, they'll be the last to know. They'll get the wake-up call. And then in late 2016, they're going to have to go back to easing somehow, and that will put everything in reverse. At that point, you'll see the dollar start to weaken a little bit, but we're not quite there yet.
Okay, Jim, and taking into consideration this scenario that you described very well, where do you think that we can find value for investors? Yeah, nowadays maybe we can expect more more downtrend in commodities, so maybe it's not time to buy, or maybe time on the dips, it could be the best opportunity. But in a general view, where do you see value?
Well, it's a really good question, Diego. And of course, there are always investment opportunities, always ways to make money, mostly by being ahead of the curve. So I wouldn't wait until late 2016 when I think this next easing cycle begins to look at commodities. I mean, just because they're down a lot, it doesn't mean they're going to go down a lot more. It just means that they're not going to go up right away. So there are some good entry points right now. You know, the price of oil has come down to at least in U.S. dollars, the high 30s. It's not going to go a lot lower than that. I'm not saying it's going to go up a lot. It probably has a ceiling of about $60 a barrel. That's where Saudi Arabia needs to be to destroy the fracking industry. So it's probably a ceiling of $60. There's probably a floor in the high 30s. It's not going to go to $20 or $15 in my opinion. So this does look like a very good entry point for oil, and really well-run energy companies. Some of the large energy companies that are not going to go out of business. They're going to get stronger in the years ahead. So this is a good entry point for that. So I agree with you. I think there are some good opportunities right now. We don't have to wait for the Fed to wake up. We can take advantage of them ourselves. Also, I'm very, very bullish on Argentina. I've been to Argentina a number of times. My oldest son went to university in Argentina for a few semesters. We visited him. My wife and I have been there. We've skied in Argentina. We love the country. I think it's a very good story right now. As you know, things get bad and then they can't get any worse and then they get better. So I'm looking closely at Argentina right now. I think there's some good opportunities there.
Okay, that's good news for our subscribers and for our investors also. And let me do the last question. Do you think that we are entering in a turning point for Latin America? I mean, in politics that could change the economic environment, or you see that maybe the thing that happened here in Argentina is an isolated case, and we are continuing with these populist policies that damage a lot their economies?
It's a really good question. Probably a little both. I was when I was in graduate school in international economics, I was actually a Latin American studies major. So that was some time ago, but I did study the history and economics of Latin America very closely. And the one thing I would say is that it's a diverse area. I think Americans tend to sort of look at it homogeneously, and that's a mistake. Argentina, Chile, Brazil, they all have their own dynamics. Having said that, there are trends that I think that we can look at, and one of them is the fact that we are seeing some positive signs in politics. Now, we've just seen congressional elections in Venezuela in which the opposition party has done very well. Obviously, Argentina has a new president, a little more pro-economic, pro-deregulation. So we have some good signs in Argentina and Venezuela. Brazil's in quite a bit of turmoil right now. We all know what the story is in Brazil. But again, things get bad before they get better. So I don't want to forecast how the impeachment of Dilma Rousseff is going to turn out. But I think this will help to. Right now, investors don't like uncertainty. It's not about left versus right, liberal versus conservative. Investors, capital allocators don't like uncertainty. So anything that reduces the uncertainty is good. So I think Argentina and Venezuela have some good news coming out. Brazil in quite a bit of turmoil right now, but maybe in another 6 months that'll be a place to look.
Well, okay, Jim, I thank you very much your time. I appreciate your thoughts, and we will follow every recommendation you make about not only Argentina, Brazil, and Latin America, but the whole world. It's interesting your view, the way you think, and the way you forecast many economic figures in the world. Thank you very much. We will keep in touch soon for more news.
Thank you, Diego.
Goodbye, Jim. Bye-bye.